Hi Steve, hi James. Thank you for joining me to talk about the trades we're making this quarter. To begin with, we're slightly adjusting those defensive positions within portfolios. Why are we changing them now?
Well, defensive elements within our portfolio, they're really there to shore up portfolios. If we see bouts of volatility, any downside within markets, there's a couple of ways that we access those defensive elements, and that's through sector-specific allocations, notably healthcare and utilities. Now, within the portfolios, we have explicit healthcare exposure, and we access utilities through a global infrastructure strategy. Since launch of the portfolios, the equity component has seen about 12.5% allocation to these defensive elements. In terms of defensive positions within portfolios, these really help shore up positioning portfolios during periods of increased volatility or downside moves within broad equity markets. In terms of the size of that defensive position, that really comes down to a view on recession risk. How much risk do we think there is of recession in the US economy, the world's largest economy? If there is a US recession, that could have detrimental impacts for global risk asset prices. So we've really anchored our defensive positioning to that risk of recession. Now, since launch of this discretionary portfolios, we've maintained a sizable position within defensive sectors, notably healthcare and infrastructure. But as of late, that recession risk has trended somewhat lower. So I think it's appropriate to reduce that overall defensive positioning. So in terms of the overall equity component of portfolios, that reduction has been from 12.5% to roughly 10.5%. So about a 20% reduction in defensive positioning across portfolios.
Okay, that makes sense. And the proceeds from this trade, where are we investing them?
Okay, so there's three main areas that we're investing these proceeds. Firstly, US equities. Now, I've mentioned we've seen recession risk in the US has gradually reduced somewhat lately, so that warrants an increase in US equity exposure. But there's two key areas of risk within US equities, one being concentration risk and valuation risk. Those two areas are driven largely by the technology sector, those mega cap tech businesses. So our increase in US equity exposure has been in a way that limits those two key risks for our portfolios, taking an equal weighted approach, a broad level of exposure diversification at the sector level. Other areas that we've increased, we've marginally topped up our Japanese equity exposure. We still like the long-term growth story for the Japanese economy, the ability for Japanese businesses to grow their earnings and return that to investors through share price appreciation. And that third area that we've increased exposure has been to UK equities. Now, UK equities are trading on more favourable valuations versus the likes of the US. So we like them in that sense, but there's also the ongoing political uncertainty in the UK. So we focused more so on UK large cap businesses. These are large multinational corporations with a high percentage of their earnings coming from overseas sources. So that really limits our UK domestic economic exposure within that portion of portfolios. We've also complemented that with UK dividend paying stocks as part of that trade. We think those businesses that can maintain or even increase their dividends, that will reward investors through share price appreciation going forward.
We've made some changes to that specific financial sector exposure, haven't we?
We have, yes. The overall financials sector exposure has gone unchanged within portfolios, but we've kind of rejigged our allocation under the bonnet somewhat. So we've held broad financials exposure for some time within portfolios. A large constituent part of that has been the banking sector. Now, banks are a lot better capitalized than they were pre the global financial crisis, and they also benefit in a higher interest rate environment. So we're maintaining exposure to banks, to broad financials, but at a reduced weighting. The proceeds from that reduction have gone into an insurance-specific investment strategy. The thinking behind this being, if we're in an environment where there's continued inflationary pressures, we don't know where inflation is going to settle, but there is the risk of upward pressure on broad global inflation, and those proceeds are going into a specific insurance sector allocation. We think there's likely to be continued upward pressure on inflation. We don't know exactly where inflation is going to settle over the longer term, but we think there is the risk of persistent inflationary pressures, certainly with oil prices, any knock-on effects there from the war in Iran. So yeah, that insurance allocation will help soften that for us, that risk somewhat. Insurance as a sector has demonstrated a good history of being able to provide good consistent returns, good earnings coming from those underlying businesses. Within that allocation, we're really focused on short-term elements of the insurance market. So think property and casualty type insurance, so they can really embed inflation risk within those renewals.
Okay, thanks guys. And thanks very much to our investors for your continued support.